us as a nation, I think we're either number 1 or number 2 in the planet for the biggest overspenders, as in individuals. We spend more money than we earn than any civilization, well, not civilization, any sort of nation on the planet at the moment, which is crazy. I don't know why. I would have thought it would be the US, but we're really ahead of our game in that respect. And it seems to have plateaued a bit. However, we're still spending 50% more than we actually earn. Our debt is 150% of our disposable income, which, it is quite scary. So who knows what may happen. So when you see all of these things converging, it's hard to believe that things are rosy now. And believe me, I'm the number 1 critic of my own research. I spend more researching why the hell I'm wrong than looking for evidence that backs my sort of stance up. I'd like to be, if I am wrong, I'd like to be the first person to find out that I'm wrong, if that makes sense. So, you're probably thinking, with all of this crap going on, why the hell are my index trades screwing me over? So this year, I've had a really shocking trading year. I'm about 1% down this year so far, which isn't much, but really I like to be a good 20% up by this point. And it turns out, as you've already seen, that my currency trades have been great. My indices trades have been letting me down. They've been sort of holding me back. So I've stopped trading the indices, as you know. Now, in answer to this question, it's all about volume. And when you follow the breadcrumbs, volume sort of leads us where to, or the answer of what the hell's been happening. And if you type in Google, what the hell is volume, you'll come up with something like this. And long story short, it's basically the amount of contracts or shares traded within a certain period of time on a particular market, S&P 500, the German DAX, whatever it may be. So I then found a really cool website called economagic.com, and it's basically a really cool, just raw data type website. And luckily, it goes all the way back to 1950, and it shows you the volume, the S&P 500 volume, all the way back to 1950. And back then, they averaged about 2.2 million contracts per month, which is not much. And then as you scroll down, it's a pretty long page. It peaked with 7.63 billion shares on Q3 of 2009. That was when literally the market was capitulating. We hit those all-time lows. And then if we fast forward to now, we're averaging around 4 billion shares per month. Now, obviously, all these stats are quite hard, and we're all traders, so we like charts. So that's what it looks like. We had nothing, oh my lord, and something interesting is happening. So volume has dropped 50% pretty much, yet the stock market has risen, call it another 50%, or if not more. So what does that mean? And what's happening is that there's a divergence. So this is the S&P 500 since 2009 to where we are roughly. Well, we're a lot higher now. It's an old chart, but if you look at the volume, it's dropping away. Now, in trading with divergences, what tends to happen is that the market will eventually follow the bigger indicator, and in this case, volume is everything. Volume really is everything. So it is just a matter of time before the market does roll over. But what this also shows us is that the public, the average Joe, is not playing in the market anymore. Well, they are, but not as much as it used to be. So the market's massively rallying, yet the volume is going down, which indicates that it's only the big players playing in the market. So I thought, okay, that's interesting. Well, who exactly is playing with what? And this leads us to another. This just shows you that the volume is going down. We'll come back to that in a bit. Now, this sort of leads us to a thing called ERISA. So hands up who's heard me talk about ERISA before. Okay, one. You've been around for a while. Not that you're old, you're not at all. So ERISA is a thing, it stands for the Employee Retirement Income Security Act. It's a US thing. And what happened in 1946, they thought, right, let's create this thing called an IRA, like a Roth. It's like our version of a pension account. And the reason it was so appealing for the Americans is that it was tax deferred. It wasn't tax-free, it was tax-deferred. So they could just park money in this big old pension fund for years and years and years. And the thing is, the tax man always gets paid, always. And so as a part of this ERISA type thing, it says by law, the moment someone in the US turns 70 and a half years old, they have to start withdrawing from their pension fund. And so that's when the tax man gets their their pension and their payments, their deferred payments. And what happens is a huge amount, at least 51% of these IRAs are linked to the stock market. So this is a video in 2012 with one of my first ever presentations to friends and family.
Baby boomers hit 70 and a half years old, and that's 750,000 people. 2017, the next tranche, 1.2 million people turn 70 and a half years old. So, what happens if, over a period of 10 to 15 years or so, 75 million people start taking money out of the stock market? It's going to be the biggest crash ever. And you don't have to know too much about the financial world to know that stock markets only go up when money is being added to the markets, and things collapse when money is being taken out. Take the 2008 subprime mortgage collapse.
So basically, 75 million baby boomers, well, in the US, by law, will have to start withdrawing from their IRA. And look what's been happening. Hedge fund after hedge fund are having huge outflows. And now you probably think, oh no, this is just private investors. No. Where do you think a lot of these pension funds invest? Yes, they put them in mutual trackers like Vanguards and whatnot, but some of these pension funds also go to hedge funds. And all of these hedge funds are having huge outflows. So it's a mix of the IRAs and also the private investors. But long story short, capital is being extracted from the market.